Hi, everybody. Welcome this week to the Middle Class Investor. This is Seth Martin, your host. It's about 3:30 on Saturday, September 23rd, and looking at a chart of the S&P 500 here, and you can see that, really we had kind of a doji week or a week of what we call indecision. That's what a doji represents. That's this candle pattern right here. Where the market opens here, runs up, runs down, and then closes near where it was. And there's nothing compelling about that other than we really have the same possibilities we had last week. This could be kind of an unusual corrective pattern, which now I'm starting to think maybe it's not. Like this is maybe the last move up. I've been talking about. I'm talking about this. Actually, this whole move is the last move up, but I'm specifically talking about this move right here being the last move up. If you recall, for those of you that were in here last week, we were talking about. Sorry about that. Talking about this potentially being what's called a flat corrective move, where the middle wave is higher, closes higher than the first wave down, and it still could be that. I tell you what though, it's in a scenario like this. Okay, if you have a flat, that means that technically means we should make one more new high. But if you look at the difference between this and where this one more new high is likely to terminate, I'm starting to feel like more and more that this right here, this amount of movement in the market is just not worth what the potential risk could be. Because when this pattern is complete, this 5-wave move up here, where we're going is to this blue box here. I mean, we might stop here a little bit and bounce a little bit, but ultimately we're going right to this box, and that's a pretty good move. I mean, that's let's just see what that is. Whoops, screen moved. Let's just calculate that. Let's say it's right there to right there is almost 8%. 8% on the S&P 500, which, golly, that's 8% is, in some years a pretty decent year in the market. So I just don't know that it's worth it really to keep holding stocks in your 401k right now. I mean, everybody needs to make that decision for themselves. You can see we've got a little, this still is even though we've made a higher high here, you can still see. I mean, it's kind of weakening. Excuse me. And if it rolls over, let's see what it's doing on a daily, just for grins. Let's put it on a 1-year daily. Yeah, see, it's kind of rolling over here. Although this is a little bit higher, but see, it's significantly lower than these momentum areas back here, and these were lower prices right back here. This was a lower price than this, and yet the momentum is continues to wane. So I don't know. I mean, we'll see. Ultimately, we'll see. The market will show us what it's up to, but I think you're playing a dangerous game probably if you're still holding here. That's my opinion. There's a lot of people saying, "Oh, this is a new market." It's the same old story. I mean, you start having a market where it's just going up and up and up, and you start hearing people saying, "Oh, this time it's different." You'll hear people say, "Well, the market's pretty thin." There's Google's going up, Amazon's going up, Facebook is going up, but really nothing else is going up. And people will say, "Well, this time is different. Technology is driving the economy." Blah blah blah. They have all these sayings, and it's really never different. I mean, that's what you really need to know. It's never, ever, ever different. It's always the same. It always results in the same, um, you know, gnashing of teeth and regret, I guess. Right now, you've got kind of a hope strain in the market, a lot of hope, and that hope, tends to diminish as people start losing their money, and they start regretting, oh God, I wish I sold, and stuff like that. And there's nothing. Cash is a position. It's not a good long-term position strategy, but there's nothing wrong with sitting in cash if you think um, if you have good reason to believe that the market doesn't have a lot more upside. Let's look at we'll look at volatility real quick. Volatility remains low, very very low, historically low, and that's just another piece of evidence as to why you should be very very careful in this market. We kind of busted out of here on some pretty high volatility, but it just continued to come in, and anything around this line is historically low. I think this was a record low here, but anything around this line is just historically low. Never been here before. So just another reason, another piece of evidence to be careful. Let's look at the short-term Treasury. As you know, the Fed elected not to raise rates, and I suspect it has more to do with this short-term, this 13-week Treasury yield pulling back. But I will tell you that if this really starts to take off, the Fed will continue to raise rates. There's no doubt about it. The Fed does not set rates, they follow rates. And speaking of rates, the most important rate, of course, is the 10-year Treasury. And you can see let me back up. This is probably zoomed in well enough. We had this run up from this low. I've got highlighted here, which is an important low. So we had this run up, and we've had this long, protracted pullback. And we talked about all along in here where the potential places were to pull back. We said, we closed the gap minimally, but it might pull back to this midpoint of this large white candle right here, and doesn't look like it made it quite that far back. But it still could pull back. I mean, we're still not, we technically have not broken this downtrend line. And so until that happens, there's still a potential to say come into this area here. Let's just highlight it right here around the 50% retracement area. Probably what'll happen is if we get a significant sell-off in the market, you'll get a momentary rush into bonds, and you could have yields pull back even lower here, or let's say let's make another one, here, to the 62% retracement area. So if you're still holding bonds, it's not the end of the world. In fact, if we get a market sell-off, I think you'll definitely see some sort of move down in yields. You're going to see, to here, or maybe even to here. But then that's probably as good a place as any to start thinking about selling those bond funds. Now, if you're holding bonds, that's a different story. It depends on the duration and how you have them laddered and things like that. But that's a more sophisticated type of investment strategy. It's not normally what people are holding in their 401ks, so we won't get into that. Let's check out these countries. I've got my charts back together after they changed the whole profit charts deal. And so this is Germany, and we saw Germany break the downtrend line and slowly move up. We've had this box on here for I don't even know how long, a long time, over a year. And you can see now we're in that area after this long consolidation here. And this is kind of key because sometimes when you have one of these long consolidations, it kind of marks the end of the move. Unless it was like a really large consolidation, then there might be more move here. But this consolidation is pretty. It looks like it fits within this trend, and so this might be it for Germany, and we might start to see Germany work its way lower like so, and all the way down to there. So Germany looks like a great place to move to the sidelines. Japan has been in that box for a while, but we still don't see kind of a some sort of fourth wave looking thing. I mean, this kind of looks like maybe a fourth wave, but I don't know. To me, this could still be the middle of a third, so we might need more like a consolidation move down, a pullback move down, and then another run up. The United Kingdom is clearly weaker, although if this is an ABC, sometimes it does get stronger in the C wave at the very end. See that a lot. In fact, I think I can show you that. If I do see that in one of these charts, I'll point it out. But a lot of times you'll see, if you're getting an ABC, the last little bit of the C wave can get pretty strong. But I would expect, the United Kingdom to, pull back somewhere in here, at least work its way down to the other side of the channel, and maybe lower. I think the U.S. market is going to have a pretty big impact on all these other markets. So I think the key is to focus on the U.S. market and make your decisions there. This is crude oil. Crude oil has this huge ABC kind of move where I'm expecting it to move back into here, but it could be in a longer term consolidation. We're kind of drawing some stuff on here, but where you get like a, I don't know if I want to draw it on there or not. I guess I could. Where you get something like this, where you have your first move up, and then you get like say a B, and then a C, and then a D, and then an E to about there, and then a new low. So if that's the case, then crude oil is going to be trading sideways, or I mean, you could trade it. You could sell some calls up here and sell some puts down here, maybe iron condors, things like that. I don't even know if everybody, people listening to this program even know that, but there's some things you can do, but it takes some additional knowledge. What this tells me is maybe don't look at any crude oil stocks, anytime soon, especially the production ones. There's still a lot of bankruptcies and things like that need to happen in that market space. They haven't even begun to happen. So, I mean, you're not going to see ExxonMobil and Chevron and companies like that file bankruptcy. But these production companies that are actually drilling for the oil and stuff like that, that's where you could see that type of flush out before this really starts moving higher again. Let's look at gold and silver. Gold's been pulling back here the last couple weeks, which we thought it maybe could, because this looked pretty symmetrical, and but it looks like maybe it's nearing the end, and I think there's a good chance gold starts to make its way up and probably terminate somewhere just beyond this pivot. So maybe somewhere in here. I mean, and now it could be, again, it's one of these markets it's just tough, because the moves are this whole move is so big. And what I mean by that is it goes back so far. Can't seem to. me see if I can, yeah, there we go. So, you know, if we put like a, see, do we have a 20-year chart on here? Yeah, see, we're already on, but you can see this bull market started way back here. So this is a huge move. This is likely, you know, the first wave of the next degree trend. And so we should expect some sort of A, B, C, and then some lift off to the next wave up. But whether B comes down here first and then up, or if it starts to make its way up now and then come down, it doesn't really matter. In fact, this, if you look at how long this is from here to here, this is not nearly long enough yet. If this is A, which it likely is, B is going to have to be about as long. So it could very well be that gold comes down, you know, where this is an ABC, ABC, and then ABC up. So we could have, you know, move down to here and then start our C wave up and terminate somewhere up here. But and then once it's terminated up here, then fall down for the final corrective part of the wave before the next big bull market starts. So I mean, we're talking, you know, 2020, 2021. I mean, it could be out there, maybe even 2023 or 24 before gold really finds a real bottom, and then makes its next wave up. So that's going to be kind of a difficult time, I think, in America. Probably, you know, from 2018 to 2022, it's probably going to be pretty tough in the stock market. But then once this inflation move starts, once gold really starts to inflate, or the dollar starts to inflate, you're really going to see gold take off, and of course the stock market will take off. It just won't, in real terms, it just won't be worth as much. Proctor does a good study on this, and maybe I'll find a chart where maybe I'll do it next week or something. He shows a chart of the Dow priced in gold, in ounces of gold. And you can see that we've been in a bear market, you know, basically since 2000 in terms of real money. And so far it hasn't really affected, I mean, it's affected the job market. You can clearly see that. It's affected other aspects of our economy. But if you've got a decent career and you're doing a high value job, you really haven't been too overly affected by this economy, which is kind of interesting. It's sad also because there's a whole group of people, there's a whole group of class of citizens who are just struggling like you can't even imagine, and the government just keeps layering more crap on them, you know, Obamacare and all this other stuff. So I don't know. Gold is gonna be one of those things that we can look at, and it'll really tell us about our standard of living, about just the overall health of our economy and the health of our government. So I think it's going to continue to be something interesting to watch, but it very well could come down here. And let's draw a box. Let me get a tool here and draw a box below here. I mean, we could easily come down here first. And this is just the nature of the market. I mean, I know it probably sounds like an economist. On one hand, we could do this, and on the other hand, we could do that. But in fact, I'm going to erase some of these lines, and I'm going to use a different tool just to kind of estimate some stuff. Let's see. Let's get rid of some of these lines. They're just not necessary. Well, I'm going to leave that one, I guess. So I'm going to get something called a Fibonacci extension tool, which is right there. And we're going to pretend like this is the A. Let's see, A, B, C. So how do we want to do this? A, B, C. Yeah, so let's say this is A, and then we're looking for an A, B, C. Okay, so let's start here. Click there, and click there. So The 100% area is right here where you would expect it to be, just below this low. So I think this is a good area. This 1105 area is probably a, if gold is going to pull back first and then go up, this is a great area to expect gold to go to. And if you've got kind of that time horizon, you might still be able to take a position there, because we're not too far from the high here. So you could take a position, maybe see if it pulls back a little bit next week and buy or sell somewhere in here, and then let it roll over and come down. So silver, same scenario, except maybe silver is going to, I don't know. You never really see gold and silver diverge too much. So maybe silver's got to come down pretty low here, if not all the way down here, and then rally up into this area. But I think, this ABC, this B wave is probably at some point it's going to come up here into the $23 area before it rolls over. So gold and silver, interesting market, but the middle waves are always difficult places to trade in because there's a lot of overlap, and that's just the nature of a B type wave. Let's see, I've got some currencies, but I was going to look at those in NinjaTrader. Got my NinjaTrader working again. So let's look at the Euro US dollar. You can see we're right at this decision point. So we should see the dollar strengthen and the euro begin to fall into this area. It's a great potential short. You wanted to go short here with your stop just above these highs, and play for a move down into here. Let me go back real quick to, I do want to pull up the euro in here because I want to look at I just want to look at a little chart information. So if you look at like an hourly chart though, because let's say we're trying to time things a little bit better. Now let's look at a 4 hour. We don't need to be in an hourly. But let me zoom in here. Okay, so the old high was here, right? So this could be, we could have a triangle forming here, okay? And I noticed this the other day when I was looking at the euro, because I've been looking for a place to go short on the euro. So you got some sort of consolidation here in the euro, and it doesn't look finished, right? You got A, B, C, D. Maybe it goes up a little bit and then down. So A, B, C, D, E, and then maybe a new high, right? Out here to a new high, and then maybe you want to go short here, on the euro, if that interests you. But it very well could be consolidating here. It looks like, what's a consolidation is nothing more than the highs are getting lower and the lows are getting higher, okay? And then you get a breakout, right? Probably break out into here, pull back, and then take off and make a new high. So great play. It's probably going to be pretty violent too. When it breaks out of here, it's probably not going to go too high for too long. It may last a day or something, and that's about it, and then immediately roll over. So if you're interested in shorting the euro, you want to probably pay attention for this kind of action, and then some breakout to new highs. All right, let's go back to but we're right in there, right? The decision point area is telling us that all trades in the future should be in this direction, not in this direction. Now, if we come in here next week and we've got, a closing bar, or, let's say the bar closes up above this decision point, and then the following week it closes higher again, then this decision point's not valid. But as of right now, it still looks valid. So we're going to be looking for potential trades on that market. The British pound. Let me go back here because I want to show you the large picture on the British pound. We've been talking about that. Let's go back to the weekly. So this huge move here, right? Because one of the things I was talking about is what can you invest in when all hell breaks loose. Well, the British pound might be a good one, but we need to pull back, and we should be getting a pullback here pretty soon. If the dollar strengthens, the British pound is going to pull back, and it might pull back in some sort of ABC like so. And certainly if you can get it, if you can get the British pound down here where I've got this yellow box, this yellow rectangle around 1.22, I mean, that's just going to be a great place to get long the British pound. And then from there you could literally just not even look at it again until it gets up here into the 1.7 area. So great potential long position there on the British pound. This is we're right now, the reason you wouldn't go to long right now is we're coming up real close on this decision point area. In fact, it looks like maybe we've already hit it, so we could get a sell-off starting next week and then kind of make our way down into here. But like I said, if you can get into, to me, there's a couple. Well, let's just put them on here. There's a couple likely places to pull back to. At minimum, it's going to pull back there. But I think it's likely to pull back a little deeper, maybe there, or maybe even there. But I think that's about it right there, 1.19. So look for those areas. Look for potential setups in those areas. So, what could a setup be? Well, it could be, let's look at this pullback. Let's zoom in on this pullback, and I'll show you what I'm talking about. If we were just, if we saw, okay, we're going to wait for a pullback, let's say we thought it was going to pull back into here. We would wait for a close below, a close above the low day, or the low week in this case. Well, this right here is the low week. The next week, it didn't close above, so that's not a trade. The next week, this bar, this little blue bar right there, it didn't close above this bar, so that's not a trade. Here's your new low week. This bar didn't close above that, so that's not a trade. You wouldn't even have a trade to the long side here until you got into this area, way over here. And then the first thing it did was pull back for a few weeks, and then it finally made its way up. But you could do the same thing here. It'll keep you from going in and getting out, going in and getting out. Just wait for, like in this case, if you're going to go long, let's say you missed this right here and you waited for a pullback. Well, here's your low week, right? Now here's a close above the high. Here's the high of the low week. So you would get in on this bar and be long. You could use the same strategy in a pullback to each of these places. Okay, it's a good way to do it. It's non-emotional. You don't have to sit there and fret over it or whatever. So U.S. dollar JPY is another one. It had pulled back. If you look at this previous, so what was the previous swing high? It was right here. So the low into the previous swing high is right here. So we would get a DP off of this area right here. And as you can see, the market pulled right back to there. And so this would have been a great, this is what I like about MT Predictor. It gives you great signals at just the right place. And just to show you there, if you were to take a trade setup off this, you would already be out in this case, because this is well, DP trades usually aren't very long. They're usually 2 or 3 to 1. But it's if you're trading every day, if you're almost like day trading, that's a good trade to take. So anyway, let me leave that DP on there. So for me, okay, there we go. All right, I guess we can look at these other currencies. The Australian US dollar. It's been going up for a while. It's got a little pullback here. Nothing happening so far. Let me put this on a weekly. I've got to somehow put that one on a daily. So Australian US dollar, let's see, the low is right here. The previous low was right here. So the swing into a high off of that low is right here, so the DP would be all the way back here. And you can see we're at DP resistance. We've had some bars kind of get outside there, but we haven't really had a close. I don't know, I guess this closed outside there, but then it immediately sold off. So to me, this hasn't definitively closed outside the DP yet. So to me, this still looks like I'd be looking for short positions on the Australian US dollar. And I've got the Euro Swiss franc and the Euro British pound. I mean, I've got some other things here, but I want to show you, I want to go show you the ES because it is at 5 waves here. So what does that mean? That means, you know, we're likely to get a pullback at a minimum into this area. So back down to 2,300, which would be 200 points on the S&P, which is not a lot. Certainly well within a long-term type of investing model. But like I said, the much larger picture is that the market is at the very, very end of a very long-term super cycle degree bull market. So, and that brings me to the last thing. In last month's in the September issue of Elliott Wave's forecast, they had this graph, which I thought was really interesting. And so what I'll try to do is explain it. This is a graph. They graph all kinds of stuff at Elliott Wave, but this is a graph that tries to measure the appetite for risk in the mutual fund equity market. So, you know, if this plays right into 401ks and things like that. People that have 401ks, they're investing in equity mutual funds. Okay. Now you can also put your money in a 401k or an IRA in a money market fund inside the 401k. So what this is telling us is that because the equity part is on top, the slope is in this direction toward appetite for equity. So back in 87, okay, we had a small bear market. This is 1-to-1 right here. Okay, I left off the legend over here. You're just gonna have to trust me, but this is 1-to-1. And then at the top of the .com bubble, this was about 3-to-1. This was about let's see, this is 3, so this was about 3.5-to-1 or so. And then up here, way up here where we are, if you can even see that on this, whoops, let me move. Yeah, I can't really move it. Up here is 4.75-to-1, so that means for every dollar potential investors have in money markets, they have $4.75 in equities. And of course, every time this, and you can see there's a trend line right here. Every time we've gotten to, you know, one of these points, it's sold off dramatically. We've had a bear market. Here, had a bear market. So this is a pretty reliable indicator. It's not something you want to mess around with. If you want to, you can search on Google, and there's a little video that talks about this in more detail. And if you search on Google under Elliott Wave, this 30-year signal for Elliott Wave, or Elliott Wave International 30-year signal flashing red, and there's a video that talks about this chart, and you don't have to subscribe to look at the video. So I highly recommend that you do that. And with that, I guess we're done this week. So I appreciate you coming in and listening to my videos. I think we're getting to the point where it's really going to pay to come in here and watch these videos. So if for no other reason than you get to avoid the bear market. So, you know, start sending these to your friends, your family members, you know, just whoever you want to. If you want to comment, you can comment in this comment section on YouTube, or you can get me on Twitter at the @InvestorClass. All right. Thanks, everybody. Thanks for coming in. Have a great week. Take care.